We're taking this special look over the next few days on the effect of food inflation, what it's having on stocks, on the economy here in the United States, as well as around the world. We're joined now by Sanford Bernstein's analyst, Alexia Howard. Alexia is ranked among the most accurate analysts on a number of food stocks that she covers, including Kraft, Campbells, and Conagra. Good to have you with us, Alexia. So this whole idea that companies are going to be able to pass along food input prices to the consumer, is that a relatively easy thing to get your mind around? I mean, that seems to be what companies always do, right? They don't have to eat the margin. They pass it along.
I think they've been trying to do that, and I think the last time in the spike that we saw in 2007, 2008, they did a pretty good job of passing on those price increases, but they still got a hit to volumes, so their operating profits were still harmed, or that operating profit growth slowed down. And I think this time around, we've got an even weaker U.S. consumer, retailers that are fighting to get traffic and customers into their stores. And I think it's going to be a little bit more challenging for the manufacturers this time to actually pass those price increases on.
All right, so packaged food companies going to deal with some challenges. Let's go through some of them. Talk about the cereal companies that you cover, whether it be Kellogg or General Mills. What are they going to be doing?
I think that we will see some pricing coming in cereals. We've obviously had wheat costs go up dramatically over the last several months, but probably only a couple of percentage points of price increases, maybe 2 to 3% in 2011, as opposed to the sort of 7 or 8% that we saw from Kellogg 2 years ago. Now, that might be enough to get the companies to cover a lot of the input costs that they've got, particularly because they have been working very hard at productivity as well. But we're certainly not going to see the kind of price increases that we saw the last time this went up. So
does this mean that the supermarkets are going to turn more of their attention and their promotion to generic brands?
I think we might see a bit of that. If you look at individual product categories, you almost always see a very tight relationship between price increases to the consumer and increases in volume share to private label or store brands. And I think the same will be true this time around, that the marginal consumer, even though we're seeing a certain consumer trading back out to Whole Foods at the moment, there is the marginal consumer that's still very weak, and we will see private label share gains over the next several months.
I know that you don't cover Walmart particularly, but I mean, does this mean that things are good for Walmart because they sell in bulk like that?
I think they're struggling at the moment. I don't cover them, but the dollar stores are kind of eating into them a bit, so they've changed their strategy quite a bit over the last several months, and that causes some problems for the packaged food companies too.
All right. We're taking a special look at food insecurity with a guest who has some insight into the stocks that perhaps can sidestep the challenge of inflation. We have top-ranked analyst Alexia Howard of Sanford Bernstein. Alexia, you were listening to Stephen talk about this idea of inflation not necessarily hurting the restaurant stocks, right, but it's more for packaged food companies. Why that dichotomy?
Basically because of the input costs that the packaged food companies have. A very high proportion of those are the agricultural inputs, the food inputs. If you think about restaurants, they've got a much broader cost base, a lot of labor, a lot of overhead, leases, rentals, and so on. And so their pressures are actually a lot lower than the companies, the big fat packaged food companies that I cover.
Now tell me about some of those big fat food companies that you cover. I want to know about what's happening with Kraft. I know that they have moved to integrate the Cadbury purchase. What does this increase in wheat, in soybeans, in corn, what does this mean for a company like Kraft?
Well, it's interesting. If you look at the packaged food group now, you've got some companies that are under huge amounts of pressure. If you think about Smucker's, for example. Kraft is somewhere in the middle of the group. In fact, because their biggest input is actually dairy costs, the year-on-year increases in dairy costs actually peaked last quarter, not this quarter. So even though it's not going to be easy, we estimate the COGS increases will be roughly in the 5 to 6% range for 2011. That's a little bit higher than the sweet spot, companies like 3 to 5% COGS growth, but it's not dreadful. So, and it actually starts to get easier over the next few quarters.
Do you like the shares of Kraft?
I do, yes. The integration of Cadbury, I think, will give them a lot of cost synergies and over time some more revenue synergies. The market share trends are slowly improving here in the U.S. They seem to be about to pick up their innovation pipeline quite nicely. So it's really all about margin expansion, particularly in Europe.
Now tell me about what's happening with Sara Lee, because we know that the company has basically decided that they are going to split themselves up. But when they came out with their quarterly report, you had to pay attention to increases in cost, because that was at least the culprit for some of the problems that the company is facing right now. And then bring in the whole coffee element, because so many companies seem to have focused on coffee, and yet coffee prices, as well as sugar, they're going up too.
Right. Yes, we are seeing a lot of pressure in coffee right now. The Arabica prices are up 65% at the moment. And certainly when Sara Lee reported yesterday, the margins on that international coffee business were down over 700 basis points. So it is
7%
challenging.
for those of us that don't do the point thing.
It's challenging right now. So they are going to feel that pressure for the next couple of quarters. But by the time we get into 2012, things should start to get a little bit easier for the company. Once we get into calendar 2012, of course, we'll see the split. And then I think you start to look at the sum of the parts value of the company. That international coffee business has 30% of sales in emerging markets, an average profit margin of maybe 17 or 18%. It's a good business.
Someone's going to want that.
It's possible. And I think even here in the U.S., you would say that the meat business, the Jimmy Dean Hillshire Farm kind of brand, once that's a standalone entity as well, it's possible that we might see something happening there.
Are we seeing increases in meat costs? Because those cattle, they got to eat.
Yes, indeed, actually. We are seeing increases on the meat side as well. Not as sharply as in coffee, but certainly there are some pressures over there too.
Tell me about what's happening at Campbell's. We know that the soup business is a little bit seasonal. The winter is always the hot spot for soup.
Right.
What's Campbell up to?
Well, the good news here is that the commodity costs on the vegetable side are pretty benign. Campbell's over the last 3 months, even though they had a very rough time in the first quarter of their fiscal year, they saw General Mills taking pricing down very dramatically, and they had a rough quarter. This quarter, if you look at the consumer takeaway data, it looks better, and that could bode well. The company's up against some very easy comparables over the next couple of quarters. The important thing is what they're going to say about innovation for the next soup season, and I think they've been held back during the recession. They perhaps haven't done as much innovation as they should have done. But if they do give us good news in a couple of weeks' time, then that obviously would tee them up pretty well for next year.
You like the stock of Campbell's?
I do.
So you'd like to own Campbell's. You'd also like to own Kraft. Anything that you would be a little wary of right now?
Just a little bit cautious on Smuckers. I think they're doing the right things, but in the face of this very, very tough commodity inflation, it looks as though the operating profits are likely to get pressured over time.
What about something like a Conagra?
Conagra, I think, is actually the Nielsen data is the measured channel consumer takeaway data is coming back nicely. I think they've had a very rough time with rationalization of products over the last year. They did a lot of innovation in 2009, found it hard to keep up in 2010, but actually over the last couple of months it's looking a little better, but they are going to come under quite a lot of commodity pressure as we go through the next couple of quarters.
So what about the stock of Conagra?
I have a market perform rating on it, so I'm pretty neutral on it.
Neutral on Conagra, but you're bullish on the shares of Campbell's, bullish on the shares of Kraft.
That's it.
Thank you very much. Alexia Howard, always a pleasure joining us from Sanford Bernstein. Thank you very much.